Hello, Bruce Youngblood here from PensionSolutionsCanada.com. You take the commuted value, will you get crushed by income tax? Well, let's back up. Commuted value number one is taking the cash out of your pension. It's one of the options available. So you tick that box, and there's a lot of money going to switch over. It might be 500, 600, 700, 800, a million. Some big number is going to go from your employer to the financial institution. That's what we do. We manage that money. So typically, let's pretend it's 600,000. So typically, 2/3, more or less, is going to go into a LIRA, a locked-in retirement account, which is a tax-sheltered account. So that, as I said, 600,000. So let's say 400,000 goes into the LIRA. So far, so good. No tax event. The money's come out of your pension. It's now in your name, in your hands. You have named beneficiaries. It's your money. End of story. The company can leave the country. It can go broke. Pension plan can run into trouble. Doesn't matter. Your money's out. Okay, Bruce, what about the other 200,000? That's where the work begins. So you have 200,000 of cash. So first question is, how much RSP room do you have? Oh, well, Bruce, I've got about 100,000 of RSP room. Wonderful. We're going to instruct the employer to send that 100,000 directly. And most employers, most pension plans will send that directly. So again, no tax event. So now you have 500,000 parked over there, but you still have $100,000. And you may say to me, by the way, I got a severance. And, well, did you work the entire year? So you had salary? Have you been collecting CPP? Have you been collecting maybe OAS? Those are all incomes. So they all stack up. So that 100,000 in any case is taxable income. Goes in your tax slip. What can we do with that? Short answer is not much. The longer answer is, oh, wait a minute. She may say to me, I'm married. My husband has lots of room in his RSP. Perfect. Does he work? Yep. Makes income? Yep. Pays taxes? Yep. Okay, then we can lower his tax burden, lower your partner's tax burden. So the money comes in 30% withheld up front, and you say, here you go, honey. Here's $50,000. Put that in your RSP. You're going to get back some number, $10,000, $20,000 back on your income tax. So at least the family has reduced the tax liability in the calendar year. And I don't mean a spousal RSP. You can use the spousal RSP, but that's all dependent on your personal room. So what I'm talking about is using your personal room, then using your partner's RSP room. Now we've pretty much run out of options. So you still have, in this example, $50,000. You say, well, what about my TFSA? Yeah, good idea. Take the after-tax income from that $50,000, park it in a TFSA. At least you won't pay tax on the growth. You can park it there and use it next year, maybe for a new RSP. So there's what happens in a nutshell. So commuted value, yes, there's a tax hit up front. And I want you to say to yourself, is the glass half empty or half full? In other words, okay, Bruce, I had 750,000. I think in our example, there was going to be something like 50,000 payable in tax. So congratulations, you worked for 30 years. You now have an investment portfolio worth $700,000. Anyway, every situation is different. Let's talk. Bruce Youngblood Pension Solutions Canada. Jump on our site, book a Zoom call with me, and we'll talk about you.